Hi everyone, Shaun Humphries here with Assante Capital Management. Welcome to this installment of our video series dealing with various topics in the area of investment planning. For today's video, we're going to talk about paying attention to asset mix. Fundamentally, paying attention to your investment mix or asset mix is one of the most important areas that you can be focusing in on if you want to be successful with your investment strategies. Now, it's important to keep in mind these videos are sort of building on top of one another. So previous videos that dealt with the topic of philosophy around investment planning, risk temperament, and goals as an example, I'd encourage you to go back to those particular videos and take a look at them. The topic of asset mix or investment mix is built upon those videos and the content there. We really can't talk about asset mix unless we're clear on our goals financially, that we're clear on our risk temperament. So what is our appetite for volatility or fluctuation? If we haven't done some forecasting, what are our goals? What are we trying to achieve? The forecasting will help us to confirm what kind of returns that we need to obtain to achieve our goals. And it's the interaction between risk temperament and goal or return requirement that will help to define the investment mix that's appropriate for you. Okay, so take a look at those videos and then this video will make more sense for you. Okay, so let's take a look at historically asset mix has evolved. It's a robust area of study going back several decades, and there's been a number of studies that have helped to confirm that it really is your mix of investments that drives most of the performance in your portfolio and explains most of the performance. So when you talk about investment mix, we talk about strategic asset allocation. So when we build portfolios, we're not trying to necessarily time the market or get super tactical, but we will build portfolios that will be comprised of government bonds, corporate bonds, real estate, stocks, and within the stock category it could be large cap or big cap stocks, mid cap stocks, small cap stocks. Those stocks could be geographically diversified, Canada, US, Europe, emerging markets, Asia as an example, and there could be currency diversification. So it's this basket of assets that will drive the performance. And so many of these studies confirm the following. Asset allocation explains over 90% of performance. If you have 10 portfolios, you line them up, and you look at the performance of each account and compare them, it's going to be the mix of investments that will explain the majority of the return differences in the portfolio. You could have one investor that had more bonds than stocks, another investor that had more stocks than bonds, and then you look at their performance, and that mix will explain both volatility or short-term fluctuation and total performance in the portfolio. Market timing has a bit of an impact, but it's not as large as you'd think. So again, 10 portfolios, start date about the same, the timing of going in and out of different aspects of securities, markets, currencies, that kind of thing has an impact, but over a long sweep of time, it's not a fundamental driver. And the same with security selection. Had about a 5% influence on the total return and the differences between portfolios. Now again, at the end of the day, we're talking about quality stocks, consistent dividends, strong balance sheets, dominant in the sectors that they're in. Typically, those are the kind of investments you want to build your portfolio with, in my estimation. And when you looked at all these factors that drove performance, the majority was just the mix. So that's what you need to be focusing on. When you're looking at your portfolio, yeah, you want to look at your investments in terms of how they compare to other investment funds, or how did your ETFs do, or your stocks. But really, at the end of the day, you want to be hyper-focused on your mix, because that's going to drive most of the performance you're going to achieve. So part of the discussion is reducing stock and sector risk. So the reason we're talking about that is that to obtain returns that will help you to achieve your goals does imply often for many people a certain level of risk. So this whole discussion is moot if you could just go buy a government bond or a guaranteed investment certificate and get your 3% return and your goals are achieved. But for many people, they need to get returns in excess of the risk-free rate or the guaranteed rate. And the minute you have to get returns above the risk-free rate, now you're exposing yourself to a certain amount of short-term variability of return or fluctuation. And that's why you want to look at the whole area of diversification to try to reduce some of that fluctuation year by year. A great way of looking at this topic is through this concept of cross-correlation of assets. So I've got asset A Over time it's going up, but there's fluctuation over time. I've got asset B, same thing, over time it's growing in its value, but it's fluctuating. But what you'll notice about A and B assets is that they're negatively correlated. As one is going down, another's going up. And you can actually find assets that are somewhat correlated differently from one another. A good example is bonds and real estate tend to be negatively correlated to the stock market. So if you have a client who wants to be getting stock market-like returns, it may be prudent to not put everything in the stock market, maybe let's say 80% of the portfolio, but have a 20% allocation to bonds or real estate, and that will help to stabilize the portfolio a little bit through times of market volatility. So this concept of negative correlation or cross-correlation is foundational to the building of portfolios to try to achieve some sort of return outcome, but to do it for the least amount of risk possible. This is another way of looking at it. This chart is used to describe something called the efficient frontier or efficient portfolio. So on the vertical side of this graph, you've got the most amount of returns, the highest return, least amount of return. On the horizontal, you've got the least amount of risk to the most amount of risk. You then have this line that cuts across from least risk to most risk and from less return to most return. And as you see this line going up, these are all the portfolios that would land on what's called the efficient frontier, and those are portfolios that for the least amount of financial risk will have the highest probability of driving the return that you're aspiring to. So let's assume that portfolio C is going to give us over time, let's say over the next 2 economic cycles, 8 to 10 years, it's going to give us 7% a year. And portfolio B is going to give us 3%. It's less risk, so we'd expect less return. There's no such thing as a free lunch in investing. So if you want to get more return, you have to take on more financial risk. Now, financial risk is not necessarily losing capital. We're talking about high quality investments. If you have a portfolio made up of, the major banks, energy companies, telecom companies, the largest retailers, how much risk are you really taking on over the long term? I don't think a lot. But you are taking a short-term risk because stocks can fluctuate quite a bit in the short term depending on economic reports, business reports, earnings reports, economic environment, inflation, interest rates, government policies. But over time, those investments on average do pretty well. Now, I can build a portfolio that is portfolio B is going to give me 3%, let's say, portfolio C, 7%, and these portfolios fall in the efficient frontier, least amount of risk to get that return. And the mix is going to be comprised of typically, again, real estate, government bonds, corporate bonds, and stocks in various sectors, countries, currencies, and different categories, big cap, small cap, mid cap. Every once in a while, we'll have someone walk into our office, we'll do an analysis of the portfolio, and what we find is the portfolio doesn't land on the efficient frontier, it's someplace in the hinterland. And that's portfolio A. Portfolio A, when we model it, historically, it would give a client 3% returns, but look where it is on the risk profile. It's way more risky than portfolio B. Both portfolios have the same return potential. So why would you buy portfolio B or use that when you can get portfolio A when you can get portfolio B that exposes you to much less risk? So that's a really important conversation to have. Now, this client who has portfolio A may actually feel very comfortable with this level of fluctuation or risk. So why not use portfolio C? And they could go from a return potential of 3% to a return potential, let's say, of 7%. So this efficient frontier discussion helps to set some context for designing the portfolio. And you want to design a portfolio that hits that efficient frontier as closely as possible. Now, once you build your portfolio, you want to make sure you're rebalancing it. You want to maintain the integrity of the mix. So again, you have the line here, which is the efficient frontier, and you've got this image here that's denoting rebalancing. If you don't rebalance, the portfolio will steadily get more and more risky and fall out of your risk comfort zone, right? So stocks typically do outperform bonds, and as a consequence, if you don't rebalance and restructure the portfolio, it's going to get more and more risky for you. Okay, so rebalancing can happen in a lot of different ways. One is automatic rebalancing. We'll often use solutions for clients that will have a certain level of systematic rebalancing internally driven by the portfolio. So if we had a 40-60 mix, 40 income, 60 equity, the portfolio mix would be reviewed, let's say weekly. And over time, if rebalancing has to be done, it gets done automatically for the client. The next level of rebalancing typically might be portfolio manager rebalancing, where the manager will look at different stocks, sectors, country allocations, and rebalance within their own mandate that they are managing for a portfolio. And the review meetings and account reviews, that would be something that I would do as an advisor, wealth planning advisor, retirement coach. I would sit down with clients. Are there changes to their family circumstances, changes to their goals? Are we tracking in the right direction? Do we harvest any profits? Do we allocate money from one area to another because we think there's a bit of an opportunity? And so these three levels of rebalancing helps to make sure that we're pruning the garden, pulling the weeds, harvesting the profits, always making sure that that portfolio is tracking in the right direction. Another way of looking at mix is also on performance expectations. This particular chart was put together by Vanguard and Morningstar. And what they did is they looked at mixes from 100% bonds to 100% stocks on the right-hand side. And this is over from 1901 to 2016, so it's a pretty large sample size. And they looked historically at what the range of returns on each mix would be and the long-term compounded return. So we took the 40-60 mix here. You can see it was a 7.6% return over time, but the range of return in any given year is 23.7% and is a loss of 9.7% in this portfolio. So we can talk about average returns, but the mistake that a lot of investors make is they just assume it's kind of this straight kind of ongoing, I'm going to get my 7% a year and no fluctuation. It doesn't work that way. If you're getting 3% on guaranteed money where there's no fluctuation, if you're getting 5 to 6% on a portfolio where it's tied to the markets, there will be fluctuation. There's probably a high probability you're going to get your return, but it's not going to be like this. It's going to be 1 year plus 5, another year minus 2, another year plus 12, another year 3, another year minus 5, and so there's this variability that takes place. The average might be right in line with the expected return, but there's this variability. Now there's various ways of handling the variability, and for today's video we're not going to get into that in a lot of detail, but there's a lot of risk mitigation strategies when you build portfolios. One is diversification. There's another strategy we call the income wedge or cash wedge strategy. So we'll talk about those things. But the biggest thing to really remember when you build a mix is as you push out the growth portion of the portfolio, right, on the bottom side of these circles, you're going to expose yourself to more and more volatility. And as you'll see in other videos, we talk about the fallacy of market timing. We don't believe that it's a productive strategy to try to ride bull markets and then time things so you get out of the market and you miss a bear market, so you get the bull market returns without the sting of the bear. And we don't think that that is possible over time, that you'll get that wrong and you'll blow up performance. Better strategy is to stay invested but fine-tune the portfolio over time in response to changing economic cycles, your risk temperament. There are ways of being fully invested but reducing risk while you're in the markets. So this is a helpful chart to give you an idea of expected returns. This is another chart that is pretty busy. It goes from 1950 to 2011. And the bottom few lines are looking at things like inflation, T-bills, GIC rates, and it's no surprise likely to you that the lowest return investments over that time frame would be those guaranteed investments. The best performing would be small cap stocks in the U.S., big cap stocks in the U.S., but what you see here is a fair amount of fluctuation. If we go to the next chart, it's even more obvious here. So what you get is great long-term performance, but you have to be willing to go through the ebbs and flows of capital markets, and that's the trade-off. So when we talk to clients, most of my clients are not 100% equities. They've got a mix. They're not shooting for maximum return based on what the market's doing. What they're doing is saying, what do I need to get as a return? If that was 5.5%, how much do I need exposed in my portfolio to these capital markets to drive up that return? But I don't want to have any more than necessary because I don't like this volatility. But I realize intellectually I have to have some exposure to these markets to drive the returns that I'm aspiring to. Another way of looking at mix and return is this chart. The S&P 500, we looked at 1982 to 2015. This chart was put out by McKinsey Financial. Is Bloomberg data that they used. And if you look at the U.S. stock market, the S&P 500, the real return over this time period of $10,000 invested was $91,741. That's a return after tax of what they used here was 40%, and after inflation. If you looked at the global markets, it was $59,786 after tax, after inflation. The Canadian market, the S&P TSX, was $45,706. And if you look at a one-year GIC, it was 9,600 basically. So it lost ground over that time period. It didn't keep in pace with inflation or taxes. Now, most people don't relate to one-year GICs. They often say, well, I'd probably buy a 3 to 5 year GIC. 3 to 5 year GICs over that same time period, net of tax, net of inflation, roughly $21,000. So clearly, investors are being rewarded with much better growth in these categories, but again, you've got this fluctuation going on. So it doesn't mean you put everything in the stock market, but it does mean that a portion of your portfolio should go in the market. There should be regular rebalancing. You should have the discipline, hopefully, to add back in when there's market volatility, because that's when you're going to get rewarded in your portfolio. Well, it's my hope that you found this video helpful. I mean, a lot of times when we're reading content, watching content, some of you going through this material are going to go, I'm frustrated with my portfolio performance. There doesn't seem to be structure. I want some ideas, maybe some coaching. And so if you're looking for either investment coaching or retirement income planning coaching, reach out to us. We'd love to start a conversation about how our services work, to help you confirm whether there's a fit between what we do and what you're looking for. So send us an email, humphries@assante.com, phone number 204-977-8049, of course the website, ShaunHumphries.com. So again, hopefully you found this video helpful, and all the best.